Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the credit downgrade from Moody's, the impact that's having on mortgage rates, and why he's not worried about paying down the country's debt. First, I want to thank our sponsor, Rocket Close, for making this episode possible. Logan, welcome back to the podcast.
Sarah Wheeler, the U.S. debt was downgraded.
I know. You wrote a good article for us on Sunday night because there was lots of questions about this.
You know, we just have to do these Monday podcasts to talk about, on Tuesday mornings because stuff happens. Man, that was nasty. They did that right on Friday afternoon, just like when, everybody was getting done. And of course, as you can imagine, all weekend, everybody's, oh my God, 8, 9, 10% mortgage rates. People are sending me videos of people saying this is it. So I'm going to explain the debt downgrade. But before we go into that, what we're going to do is, this is for Moody's. Anybody that is Moody's, works at Moody's out there who gave the debt downgrade, we're going to pile up a piece of garbage and then shoot it into the trash can. That's the first thing that you should think about when you think about a debt downgrade and it being anything meaningful. It was trash back in 2011 when S&P downgraded. It was trash in 2023 in August when Fitch downgraded. And this was like trash. If Germany's getting AAA rating and we're done, this is why market people, even the anti-central bank movement people are like, dude, this is lame, right? I think the best way for me to explain this is back in 2011, S&P downgraded credit rating. It was a whole big thing, right? And back then it was like, oh my God, mortgage rates are going to go to 10%. The 10-year yields on debt, we have over 10 trillion in debt. We're in trouble. Literally the entire time after that, the 10-year yield went lower. QE was actually ended in August of 2011. So the bond yields actually were going lower when QE ended, which that's a whole different other conversation for another time. But in this sense, back then we had our debt downgraded the entire cycle, right? When I started forecasting 10-year yields in my yearly forecast, same forecast for forever in the last decade, 1.6 to 3%. Why? Because Fed funds rate policy is zero. Inflation wasn't breaking out. We could barely get to 2% half the time of the decade. So that entire downgrade meant absolutely nothing to the debt or anything like that. The U.S. is Godzilla on super steroids compared to other countries. So if other countries like Germany has better rating than us, you got to be kidding me. So we go further out, and I think what a lot of people forgot about, Fitch downgraded the U.S. in 2023. And back then, I think it was August of 2023, they downgraded the debt. The Fed was not done with its rate hike cycle. And for those part of the Instagram family, we're like, okay, this 434 level is really key. If the Fed gets hawkish here, man, we could go to 5% on the 10-year. And being at 5, even if the 10-year yield had gone to 5 to 5.5, even to 6.25, where the Fed funds rate, it wasn't like completely out of the norm on historical precedents. But they downgraded the debt. The Fed got hawkish. 10-year yield went up high. All of a sudden, the Fed president was like, why is the 10-year yield doing this? Then they called uncle and said, okay, we're done. We're done hiking rates. Guess what happened when the market knew the Federal Reserve was done hiking rates? What traditionally happens in economic cycles, the 10-year yield goes lower, bond markets rally, mortgage rates go lower, all with the Fitch downgrade in there.
So let's talk a little bit. Just give a backup, just a quick explanation of what it means when any of the credit rating agencies downgrade our credit. What does that actually mean?
Nothing. Depends. If you go from AAA to AA, you're just saying, you guys remember the movie Team America? It was like the Muppet. It was like I forget the concept, but they made a joke that Hans Blix was going to write a letter to North Korea to tell them that they were bad, and that's the UN was going to tell North Korea not to go for nuclear weapons. And this is basically credit agencies telling the US, you're bad. Don't do it. Listen, there's an article that I wrote in 2019. I highlighted why I thought we're going to have like 71 trillion in debt in 26. This is before COVID. This is everything. I like the debt baby is like going to be born in 2024 all the way to 2057. So just by a normal debt curve, population demographics, we're going to 71 trillion. Anybody who knows accounting would do this. It's never, the bond market knows this anyway, right? And it's like, it's not like the 10-year yield is at 15 or 20 or 25%, or countries that are like broke or whatever. So our debt is going to grow a lot faster because we're getting older. Population growth is slowing down. We're not a fast growing economy anymore, just like a lot of mature, wealthy economy. I think the debt to GDP is what, 125, 126, like Japan's at 260 right now. So the fear of it was that if the debt downgrades, that it would, like corporate bonds or something, that governments and banks would have to sell their treasuries because they legally can't hold them. That's not what's going on. It's basically like a warning shot or something. Hey, you guys better get your act in order. You guys better do it. We're going to downgrade you. And nothing really changes. And this was a tactical one because this was right before the Republicans can't pass their big, beautiful bill just because there's a few holdouts. But it was done like that. So the problem is that us as market participants, we know this, so we don't take it seriously. But for like people out there, they don't know because it doesn't get explained to them. So we always say it's trash. It was trash in 2011. It was trash in 2023. It's trash. The 10-year yield went up. Oddly enough, I thought the news from Japan was more meaningful last night. Japan's 30-year yield is like an all-time high. Japan's trade deal with the U.S. are hitting some snags right now. So I thought that meant more because when we talk about de-escalation on the trade war for China, we still have a lot of tariffs, like big percentage tariffs on everyone. And we're supposed to get like 90 deals in 90 days, and there's not much happening. So when the Japan news came out last night, it actually pushed the 10-year yield a little bit higher. So the 10-year yield, this is Monday morning. We went from, I think, 449 to 454. Now we're back at 448. Thank you all for playing. We all survived the Moody's debt downgrade. So this is just, it's not as important as people make it out to be, but it's the fact that Germany is still rated AAA, whatever, and we're double. Just seriously. That's a joke. It's embarrassing. It's an embarrassing joke. So if anybody from Moody's listening, you're embarrassing yourselves. You're an embarrassment to this country.
So Logan, this is one of the questions you get a lot when you are going around the country talking. People want to talk about the debt because they're worried about the debt. And you just said, you don't have to worry about the debt. Yes, it's going up. Yes, it's no big deal. How do you square that with, I mean, we're having this whole budget conversation and so much of the budget has to go to pay off the debt. So give us your dissertation on why you're not worried about the debt.
Okay, so the easiest way for me to explain why I don't care, why I'm never going to care, until other weaker economies and countries have debt blowups, we're not having it here. So back in 2011, people said we couldn't borrow any more debt. We're broke. And literally the entire decade, we had deficits every year. And every single year we said we have a debt monster. We're gonna pay the price, right? It's not Canada or Mexico that are going to suffer. It's the US, the wealthiest country in the world, the most powerful military, the wealthiest economy, the unbelievable middle class. We're the ones who need to be worried about the debt. Okay, so other economies get a free pass, but it's the dollar that's going to. This is a conservative mindset and a liberal mindset. There's a lot of progressives who say the debt's a problem, but for other reasons. It's never happened. Men have died in this country thinking that federal debt was like a real big problem. It's just not. We can grow the economy and keep the debt to GDP levels well far away from what even Japan is. So my contention has been that it's always been a boogeyman, and here comes COVID. So what happened during COVID? We exploded the deficit. We exploded the debt. Until the Federal Reserve started hiking rates and everything, the 10-year yield, interest pay, everything was low. Right. So Fed policy to me matters more because we have an unfair advantage. Like I always think the one of the things that's maybe not the best, the dollar's literally too strong for a lot of things in this context. So I'm not concerned because I'm going to be 50 this year, and I thank God I wasn't one of those guys that sat there and worried about federal debt for 20 or 30 years, because some of those men died going to the grave and nothing's happened. And we're sitting here. It's 2025. The 10-year yield's at 450. We just had pandemic inflation. We have $37 trillion in debt. We have $100 trillion in unfunded liabilities, and the 10-year yield's at 4.5. And the growth rate of inflation is a two handle on CPI and PCE. If we didn't have a trade war, we wouldn't even be worried about inflation happening in the second half of the year. It was a boogeyman. It was always going to be a boogeyman, because people in power need to have boogeymen, because you can't just say, don't worry about the debt, because then this group wants this and that group wants that. I encourage everyone. There's a link to the article I wrote in 2019. And I was outlining my case. Like, nothing is going to change unless inflation like really breaks out. And it was a pandemic global inflation that did it. It is now the Federal Reserve saying that supply chains are now going to be the concern going out. It's not that the dollar is going to devalue itself and we're a third world country and Mexico is going to buy Canada and Canada is going to buy New York. It's just, it was overdone. And I think this one, what I'm actually encouraged is that it wasn't as bad as it was in 2011, or even in some cases in 2023. I think people just don't take it seriously. If you really thought a country, you would downgrade their debt to like much lower levels. And we're all here. We know what's coming. Nothing's really going to change here. The debt's going to constantly grow and go. And majority of the debt we own. I mean, a really good example is China is now not the second biggest holder of treasuries. It's the UK. We were told we have commercials. Go look at YouTube and look at China owns the US. They were making commercials that, oh my God, the Chinese own all our debt. We're working for them. Y'all crazy. It's just crazy. No, it doesn't work that way. And China was selling its treasuries for years and nothing happened until the Fed started hiking rates. And then again, 65 to 75% of where the 10-year yield and mortgage rates can raise is Fed policy. Go back and look at the 10-year yield all the way down to 1910. And then look at it now and look at mortgage rates. Look at everything. There it is. Right. So I'm just like, I understand why Moody's did it, but it's like, we got all these videos of, oh, here that comes here. No. The mortgage pricing got worse today. Spreads got a little bit worse, but it's not we need to be less than Germany sovereigns, really? Come on.
I can see that particularly really bothers you.
Like, but it's stupid. It's embarrassing. It's like embarrassing. It's like a terrible basketball player coming to an NBA in practice and saying, hey, put me in the first string. Get your out of here. No.
Okay, but my question is less about Moody's and more about the debt in general, because it's like, if you have to keep paying more and more on the debt, doesn't that come due at some point? Or is what you're saying, we will always grow more than the debt? We will always be able to pay that off and it's not a problem?
We are never going to pay the debt down. It is not going to happen. It is.
And why is that okay? I don't understand. Why is that okay?
I have ran every single, look at Japan. Japan's debt to GDP is 260%. It is double ours. They're dying. 40% of their population will be dead by the end of the century, and they're borrowing at low rates, right? So this is how budget, I mean, we own most of our debt still, like we owe it to ourselves, right? That's how economies move. Remember, we're withdrawing a debt supposedly to bring the 10-year yield lower, right? And guess what happened? What happened with Doge? It was like, we've gone from 2 trillion to 1 trillion to 800 billion to 600 billion to 400 billion to 200 billion to what, poor Rand Paul, I saw him on TV. He's like, why are we needing a $5 trillion? By the way, Trump is very clever with this, by the way. Homie went out there and asked for a $5 trillion clearance pass on the debt ceiling. See, he knows how to play the game. He doesn't care about the debt. Are you kidding me? You think these are like, if you were serious, if you were authentically serious about debt, you would raise taxes, you would cut mandatory spending, and you would try to balance a budget with our demographics, which would be terrible. You'd be voted out of Congress. And just embrace the fact that you're living in the most powerful country in the world and you didn't have to worry about this ever. Right. So this is just the reality. And I had a good conversation. Somebody said to me, but Logan, the mortgage rates and the 10-year yield went up when the Fed started cutting rates. Yes. And mortgage rates fell 2% without any rate cuts. Why? Because the 10-year yield thought the U.S. was going into recession. It breached the corridor line. And, Sarah and I, we've had this talk. I said, boy, the 10-year yield is really pricing in a lot of weakness because the Fed funds rate is up there. Well, what are we doing down here? You're assuming that the economy was breaking. If it didn't break, yields shot up. And this is how it's worked for 80, 90 years. There's nothing abnormal here. You'll have bursts of inflation. War is inflationary, right? Price controls, right? The 1970s, stagflation, inflation, oil shock, labor force growth, housing was booming out there. That was inflationary. Global pandemics, inflationary. Bond yields go up. But it's really Fed policy. The United States is the only real superpower left. Why do you think the euro was created? Right? Why do you think the BRICS are trading tangerines and stuff? It's because the dollar is too strong. We are king for a reason. So these boogeyman things are not. Sarah, you and I are going to die, and we're not going to see a debt blow up. If Germany has a debt blow up, and the UK and Japan and China, then we could have this conversation when it's going to hit the U.S. shows. But guess what? The U.S., even in that environment, king dollar for a reason. Bond markets here, people come to us for safety in the dollar and everything. Those other countries, they would all explode first. And if you just had that mindset since age one, you would have been correct.
Okay. See, I mean, I think the thing that's so confusing about this is like paying off the interest on that debt is a big part of the budget. That's why when Doge was saying we're going to cut this, we're going to cut that, it's like you don't get to that level of cuts unless you're cutting Medicare, Social Security. I mean, there's just not that much to cut.
So the big items in the budgets are all mandatory payments. That's why I wrote that article in 2019. I was like, guys, the mandatory payment thing is about to explode. It's really actually years 2024 to 2057. This is before COVID and everything happened. So as long as the economy can grow, right, the debt to GDP levels, it's interesting how Bassett has now changed the tune to we got to grow the economy to a certain level. You didn't have the cuts there, right? So you cut a little here, you cut. If you were really cutting things, you're going after the big mandatory payments, which, you got to cut Social Security, you got to cut Medicare, you're going to get voted out, of course, but still, I always tell people, you live once in this world, and I've had this mindset for the last 10 years. There are certain things to worry about. This is really not one of them. If you're one of the doomsdayers, if you want to get a downgrade and whatever, the budget has to be passed, there's no balanced budgets here. It's all a lie. Both Republicans and Democrats have lied to you for decades. Basic arithmetic makes this impossible with our demographics. Why? Because we're getting older. The baby boomers, right? Our elderly dependency ratios are just about to explode because we're aging. Population growth is slowing down. Right? This is what older, wealthier economies embrace it. Embrace it. But hopefully now, after 2011, after 2023, after today, these debt downgrades aren't as material as, let's say, a corporate downgrade where you have to sell the company or you can't hold a junk status. These are two different things. And that's why you never look at household credit debt and compare it to government debt. It doesn't work that way. We've been expanding as long as we're growing a growing population, an elderly population, the debt's going to grow. And this was done after World War II. We were cooked after World War II when we had the baby boomers having kids and then everything, and then population growth. And this is the way it is. But don't worry about this doomsday scenario that we're broke or that China owns us. Those are the worst. I encourage everyone, go to YouTube and say, China owns us, and go watch how terrible those commercials were. Like the Chinese students are out of college and they're like, oh my God, the US works for us. No, doesn't work that way.
Okay. Well, thank you for breaking down what is going on with the credit market being downgraded, our debt. Let's talk about the tracker because you just released that this weekend. Very interesting. You really explained mortgage spreads and how those have affected mortgage rates. So let's talk about that.
So oddly enough, the evil villain of the mortgage rate world is bad spreads. But this year, wow, you cannot. And the thing is, I realize mortgage spreads is not the most, like, not a lot of people know about it. It's not fun. But if you did not have improvements on the spreads this year, we would not have 15 straight weeks of positive year-over-year growth data. Now, remember, when we are the last 2 weeks were 13 and 18%. When you're working from such a very low base, you can have very high percentages of growth. That first kick up, we've always talked about this. When that first kick up happens, you're going to get some very high percentages. Take it in context. It's nothing. Like if we were really bursting out in housing, we're 15 to 25% year over year every single week. No equivocation. We're not having that kind of growth. But if the spreads didn't improve, mortgage rates would be near 8% today. With 8% rates, we were not having 15% year over year growth. The builders would be in much more stress. We'd have less housing production. We'd have less new home sales. We'd have less existing home sales. So oddly enough, one of the best villains in this cycle is actually a positive story because the spreads got better. And for those that read the tracker, you could visually see we break out the spreads in 2023, 2024, and 2025. And as the market volatility compressed a little bit, the spreads got better. It wasn't a good pricing today with the spreads. They bounced up higher. But man, if we didn't have that improvement,
It'd
whole
be
different story
it'd
we're
be
talking about in
bad.
housing.
We'd be at 8%, right? More?
We'd be near 8%. And with 8, listen, when we're above 7.25, you start to really see, like, even in the like, for example, a good example I use is last year the 10-year yield was going up and mortgage rates got to 7.5%. 7.5% had out of an 18-week period in the first half of the year, we had 14 negative prints, 2 flats, 2 positives, only 2 positive weekly prints, zero year over year growth prints. Here, the 10-year yield was going lower, spreads were better, positive year to date, 9 positive weekly, 6 negatives, 3 flats, but 15 straight. It isn't much. This is not like home sales are booming or anything like this. But this is happening with elevated rates, and that elevated rates would have been higher if the spreads didn't get better. So in the tracker, I show you guys the history of spreads going back to the 1970s, before I was born. Not before Sarah was born, but before I was born. We went back there to that
So
time
rude.
frame, and we got to talk about the spreads, and then you guys could see how it moves with economic cycles. And it was really bad in the 1980s. Man, we had almost 6% spreads. So realistically, we would not have had 18% mortgage rates if the spreads weren't as bad. It would have been in the kind of the 12 to 13 range. But that's how awful the spreads used to be back then.
Okay, thank you you had to throw in something about my age. I'm not that much older than you. Well, okay, a
No?
little bit older.
Yeah. Don't worry. I'll join the 50 plus crowd in a few months.
Okay,
So
yes,
I'll be
join
right there
us.
with you.
Oh my gosh. Logan, thank you so much for explaining all this to us. Encourage our listeners, go and read some of the stories he's written. He gets into a lot more detail, and there are charts, which we can't really do on a podcast. So
Yeah, you
it
can't do it
makes
on a
it
podcast, but again, I get it. I saw all the videos. Thank you all for sending me those videos over the weekend of like people saying like 8 to 10% mortgage rates very soon because the debt's going to blow off. We're broke. People, there are jack bleeps out there who are just trying to scare you for views. And this is just who they are. Like,
yeah.
like you live once in this world. You think about you have to ask yourself, you live once in this world and you're going to be known for doom porn posting all the time. So I'm encouraged to see that people come to me first and look at this. And usually I have a one word answer: trash, garbage. These videos are garbage, right? The guy didn't even make sense. It's not even the right, so good. I'm very happy that people are coming to me and asking, and then I go, yeah, that's not it. And here we are today, that it's before we got on this podcast, 10-year yield was almost flat for the day, right? And Germany still has a better credit rating than us. Oh.
That bothers you so much. Thank you for being on. We will talk to you again soon. And thanks for jumping on a day that we don't normally have you on, but we are maybe switching you to earlier in the week, having you on Monday and Tuesday and then Friday, just because so much happens over the weekend.
Yeah, you just don't know these weekends, right? These weekends, and then if we only come on Wednesday, it'd be like 2 days after. So yeah, we're gonna come on Mondays and Tuesdays just so we could get the Friday news and then the Monday news. So and then work it from there. It's not boring.
It's not boring.
I'm telling you, the last decade was very boring. It was a very slow growth cycle. Not much really was happening on, and people over exaggerated stories back then, but those stories weren't really that big. Here, y'all got some crazy stuff going on every year, man. Trade war. It's like 24 the movie, but for economics, right? I've always said this. I feel like Jack Bauer, you know?
I love 24.
That's what I feel like 24/7. I got to do. That's why we have Instagram. Like we do 24/7 Instagram stories all the time because there's something happening. I actually saw Chloe, the comedian at the Improv.
I love Chloe.
She was funny. She was making fun of my hair too. She's like, "Wait, you got way too much hair for this crowd," because like 90% of the guys were bald and stuff, and they were like, "Oh, so."
Going to with you to a comedy club? No way. There's no way. I'm sure they pick on you the whole time.
I'm more prone to go on stage and start, busting some of my own jokes out there.
Oh my gosh. All right. Well, we will talk to you again soon. Thank you, Logan.